Okay, so this is a journal entry for loan and a corresponding rent expense. On December 30th, the company applied and received a $12,000 short-term bank loan with monthly interest expense of $100. Record the journal entry on December 30th when they actually received the money and entered the loan. So on December 30th, and then on January 30th for the interest expense. All right, so interest expense and January 30th. All right, so let's do A first. All right, so when they get the loan, well, let's start with the things we can touch, which is cash. Cash is something that we know we're getting in a loan, right? So cash is going to be debited. And how much are we getting? We're getting $12,000, right? Where did we get that $12,000? We got this $12,000 from right here. So we debit cash, $12,000. This is how much we're getting. All right, and so the credit we receive with this, the credit is going to be a liability. We have a loan. All right, we might call it a note payable, something like that. I'm just going to call it a loan. Loan for $12,000. All right, and this is what we would record right here. Loan for $12,000. All right, and this is what we would record for A. We have an increase in our assets of cash and an increase in our liabilities, and everything's in balance in the equation because our assets are increasing by the same amount and our liabilities are increasing by the same amount. All right, now B. In B, we record a journal entry for the interest expense. Now, I'm not sure that we actually are paying it or not. It's not so clear, so there's a couple different ways you could go with this. We know we're going to have a debit, and we know we're going to have some sort of credits involved here. All right, so our debit is going to be interest expense. Expenses are debited, all right? So the interest expense right here, interest expense right there is debited. All right, so this is after this journal entry. I'm going to move my line up to indicate it's over a different period. So interest expense, we know that's going to be there. Interest expense of $100, right? $100. Okay, interest expense of $100. Now the credit. What is the credit going to be? Well, the credit could be cash of $100 if we pay it right then, or it could be interest payable. Who knows? I don't know if he pays his interest on a monthly, but this person pays their interest on a monthly basis or not, the company, or if it's over, an annual basis, or if it's due at the term. So I would accept cash or an interest payable account. Either one would be fine with me. If you let's just put cash in there. Cash of 100. That is totally fine. All right. So if you put cash in there, that's great. If you put interest payable, even better. Well, not even better. They're both the same. They have the same effect. The real thing is showing that you know that it's an expense and that it's hitting the income statement here. And with that expense, you're either going to show an increase in liability as you decrease your owner's equity, showing that, or you're going to decrease your assets as a result of paying it. All right, so that's the journal entry for taking out a loan and interest expense.